When I first started as an analyst, weekends weren't for football and barbecues. They were about Excel, buried in spreadsheets, fueled by Red Bull with espresso shots. I learned the hard way that stock picking is a process. Hey Bowtie Nation, Joseph Hogue here, and today I'm walking you step by step through the process analysts use to find the best stocks to buy. A process I used to find and recommend shares of Home Depot in 2013 for a 110% return. Along the way, I'll highlight 3 stocks to buy now that I just found using this must-know investing analysis. I'll reveal that first stock next, but what I'm going to give you is called bottom-up stock analysis, and it's what every analyst starts with on Wall Street. This is what most people think of when they think of investing, pouring through the financial statements using the valuation measures I'm going to show you in this video to really understand a company and find the best stocks. Now, last week I showed you how to do top-down analysis, where you start with the big picture forces like the economy and then groups of stocks that are going to benefit before narrowing it down to which stocks to buy. I'll link to that video in the description, but I'm going to compare bottom-up analysis and that strategy as we go. Where top-down analysis starts with the big picture, bottom-up goes straight to the stocks, focusing on finding the individual winners instead of the groups of stocks. That can help it find great stocks even in the bad markets or industries that aren't doing very well. In fact, 2 of the 3 stocks I'll reveal in this video are in parts of the economy that top-down analysis would say to avoid. Finding stocks like that where others are running scared can bring out some of your best returns. But the cons of this bottom-up stock picking is it can take longer because you have to analyze each stock instead of narrowing your list down first with that big picture ideas. The biggest risk, though, is that this big picture, the economy, or the stock market is so bad that it pulls down even the great stocks you find. Whichever strategy you end up with, this right here is where almost every analyst starts on Wall Street. That's where I was in 2012 working as a junior analyst in home builder stocks, mainly because the industry was still in the shitter and nobody else wanted to cover it. And while 72-hour work weeks were the norm, basically hooked up to an espresso IV drip mixed with questionable amounts of Red Bull, I'm going to narrow it down to a process you can use to pick stocks in less than an hour. It is this process that led me to Home Depot, ticker HD, still mired in the mud with the rest of the post-crisis housing stocks, but I saw something different. I saw a company with stable cash flows in an industry that was being flooded with fixer-upper foreclosures that would make Cell Block C look cozy. And it ended up being my best call with the shares up 110% over the 3-year period, almost 3 times the return on the broader market. Let's get started with Walmart, ticker WMT, and I'm going to walk you through a lot of the analysis as we go, but I'm going to take you step by step later. And why I wanted to pick Walmart to highlight here is it's not a stock that you would consider if you're only using that top-down analysis we looked at last week. We're seeing weakening consumer spending as the economy shows signs of a recession. The jobs market is slowing down, and retailers like Walmart are having a very tough time with inflation and passing their costs on to consumers. So the big picture would say stay the hell away from consumer stocks and retailers, but this is where that bottom-up analysis can find you that diamond in the rough. With bottom-up stock picking, you start with a list of stocks in an industry, all the competitors you want to compare to find the very best stocks to buy. Here, I've listed out the top 4 in Walmart's space, but really you'd want to compare across more, at least 10 competitors or as many as are in the industry. Through following a stock or an industry, you're going to find out who that is, but you can also scroll down here on Yahoo Finance and look for this Compare To section for some ideas. Here we see we could have included BJ's Wholesale, Dollar Tree, and Ollie's as well for a broader picture. Here I've built out a basic list of fundamentals, the core financial ratios, and valuation measures. Be sure to subscribe to the channel so you don't miss our next 2 videos in the series, where I'm going to walk you through a complete list of ratios and valuation measures so you can use everything a Wall Street analyst uses to compare stocks. Here, I want to compare these by revenue growth, both over the past 3 years and what analysts are forecasting. Measuring this doesn't just tell us how fast a company is growing its sales, but can also be a clue into any competitive advantages it has over its peers, or just better marketing. Basically, the company is doing something right to be able to grow faster than competitors and take that market share. And those of you out there in the nation know the operating margin is my favorite measure of profitability and a great clue into the strengths of good management. How is management able to convert sales into operating profits so much better than its peers? We'll also compare that growth and free cash flow, and I'll explain what all these are and how to find them next, as well as 2 valuation measures to help us find the right stocks at the right price. For past revenue growth, we're going to go here to the Financials tab on Yahoo Finance, and you see here the income statement showing the revenue all the way down through costs, interest, and taxes down to net income or profits. I like to measure longer-term trends instead of just the 1 year, so we're going to take the revenue in the most recent year, this $681 billion, divided by the sales 3 years ago of $572 billion. That gives us a 3-year increase. So to get that down to an annual basis, we take this exponent here and 0.33, since it's 3 years, to get that 5.9% sales growth a year over the last 3. For the forecasted sales, we go to the Analysis tab, and here we find the estimates for earnings and revenue from analysts covering the stock. Now, my job as a junior analyst was to go blind building out these cash flow models with industry trends and other assumptions, actually building out these forecasts for revenue and earnings, but that would be another 40-hour-a-week job, so we're going to use the consensus estimates to compare our stocks here. And again, I like to use the longer trend here, so we're going to use the average estimate of the 25 analysts for next year's revenue at $740 billion, divided by last year's revenue of $674 billion, which gives us our 2-year forecast. To get an annual growth rate, we do that exponent, except with 0.5 since it's 2 years, and find analysts expect Walmart to grow its revenue at a 4.8% pace this year and next. Now, an important point here, a lot of your ratios and your valuations you can find already done for you in the Statistics tab, or any investing platform is going to show these. Here we see valuation measures and profitability for Walmart, but you always want to double check these numbers because they can be wildly off. Yes, I know it's a pain, folks, but if you're going to be investing your own money, if your financial future rests on this analysis, don't you think it's worth an extra couple of minutes? For this operating margin, that all-important measure of how efficient management is at converting sales into operating profits after paying production and expenses, we're going to go back to the income statement in the financials and look for this operating income number. We'll use the trailing 12 months number and take this $29 billion divided by the $685 billion in sales to find an operating margin of 4.3%. Walmart is converting every $100 in sales into $4.30 in operating profits. Nation, starting with that revenue growth and the margin on the income statement might give you a sense that it's the most important to an analyst, but here with the free cash flow and where you find it, here in the statement of cash flows, this is where Wall Street spends most of its time. That's because while there are 1,000,001 accounting shenanigans to make that income statement look better, legal ways to fudge the numbers to boost those profits, it's much harder to fudge actual cash coming in and going out from a company, and that's what the cash flow statement shows, so it's where an analyst does most of their work. Operating cash flow shows the actual cash in and out of the business through its operations, the core cash flow of the company. Investing cash flow is what the company spends on things like research and development of products, buying other companies, and investing in assets, as well as selling any of these. And here, financing cash flow is cash from borrowing or paying back debt, so a negative number here is a cash outflow. The company used cash to pay down debt. You also see cash from issuing or buying back the company's own stock, as well as paying out for dividends. This end cash position is a very important number for the smaller companies. How much ready cash does the company have on the balance sheet? Cash survivability in case the company isn't making money yet or hits a rough patch. And here at the bottom, this is the big one, the free cash flow, or FCF. This is the cash from operations minus the amount of investing cash flow the company has to make to stay in business. Just think about that. The core cash generation of the business minus the minimum cash investment that needs to be made to keep in business. What's left over, that free cash flow, is the cash left over to its owners, the investors of the company, so this is hugely important. And again here, we'll take the most recent FCF of $12.6 billion divided by the free cash flow 3 years ago of $11 billion, then annualize that to see Walmart grew its cash flow by 4.5% a year over the period. With these valuation measures, we're going to be comparing how much investors are paying for each stock to see which is more expensive. You can do this on a per-share basis, but it's easy enough to do it just for the stock as a whole. Now again, you're going to see this calculated for you, but it's easy enough to find yourself. Just take this market cap, which is the value of all the shares in the market, the price of each share times all those shares, so $766 billion market cap for Walmart, and then the price to sales. We take that divided by the $685 billion in sales for about 1.2 times. So investors right now are paying $1.20 for every dollar Walmart generates in revenue. And first, we can see that that's higher than they've been paying over the past year. So we can say that shares are relatively expensive right now versus what investors have been willing to pay in the past. But we also want to compare this to its competitors. And for the price to cash flow measure, we take that same $766 billion market value of the stock, divide by the up-to-date $13.6 billion in free cash flow generated over the last year to see that investors are paying 56.7 times, or $56.70 for every dollar in free cash flow generated. I filled in the rest of the data here with that same process, and this is that first pass where you compare the fundamentals across stocks in the same industry to get a sense of each. And Nation, there is a hugely important point here that we are only comparing these across companies in the same industry. That gives you a direct apples-to-apples comparison. Trying to compare the stocks in other industries. Say if we put Nvidia in here, it shows us nothing other than I'd much rather be a chip maker business rather than in retail consumer goods. Comparing Nvidia to any of these doesn't help us find the best stocks in the group because growth, profitability, and valuations are so different across industries. Now, the fundamentals here do point out some interesting analysis, though. Walmart and Dollar General are growing at about the same pace, while Costco is a beast with its own Kirkland brand, so that might be something to watch as well. Target has been the dog here, not just near term, but for a while, and points to some real branding weakness on the company. On profitability, they're all pretty close, though I was surprised to see Target the most profitable, maybe resisting those price discounts the other stores are offering to draw customers. And in this cash flow growth, we see real trouble at Target and Dollar General, a huge gap between cash generation versus the leaders, Walmart and Costco. And valuation is interesting here because it points out one of the biggest traps in investing. People think they're getting such a great deal here, getting shares of Target for so much cheaper than the others. Here, I can buy a share of Target for just 40 cents for every dollar in sales versus more than 2 or 3 times that with these other stocks. But these valuations reflect the strengths and the weaknesses of the companies. Folks, the stock market is pretty smart with millions of investors buying and selling all on public information. So a lot of times those cheap stocks are cheap for a reason. And it's that revenue and cash flow problems at Target that we see here. So here I'd say with just first impressions, Dollar General isn't worth the high valuation and the negative cash flow growth. Target I would avoid unless I thought it had this serious turnaround coming. And I would definitely want to look further into Walmart and Costco. I know that's a long process and a hell of a lot harder than just clicking over to YouTube to get your stock picks, but please, folks, take control of your money. Give this the time it deserves, and you will never have to ask the trained monkeys here on YouTube for an update to that shitty stock they told you to buy. Now, that basic analysis of the fundamentals is going to get you 90% of the way to finding the stocks that you can count on to make money, but like we saw with just those 4 stocks there are 2 of them, Walmart and Costco, both look good, and Target may be a good bet at that very low valuation if we think it can turn itself around. That's why we go a step further, digging deeper into the research to understand the revenue streams and any competitive advantages before we push that buy button. Now I'm going to show you where to find this and what to look for later, but Walmart has a huge advantage in its diversified revenue stream with US, international, and China operations, along with its Sam's Club segment. The gas station and large grocery footprint helps bring people in even when spending on other retail items falls. Walmart has also invested heavily to grow its delivery segment, booking 50% growth in store-fulfilled delivery last quarter, providing a boost to customer service and helping it compete against Amazon. And China has become a real growth driver here, with 30% increase in sales in the region, where a lot of competitors like Target have no exposure. So I like how Walmart has grown its larger grocery footprint and the gasoline segment to bring people into the store regularly, and right or wrong, it's been able to stay politically neutral, so hasn't been affected by boycotts like Target. It's these competitive advantages that have helped it beat others like Dollar General on revenue growth, while not getting into a price war so it could beat Costco on profitability. So this has produced the 26% return over the last year and future returns from here. Before I show you the rest of that process for picking stocks, understand Wall Street analysts don't start with the 8,000 stocks traded on the exchanges. Even this approach means narrowing it down, with most analysts specializing in a specific industry or a sector, covering only those companies in that group. Now, my background in real estate, both as a commercial property agent and in construction, is how I was able to get in as a home builder's analyst in 2012. It means analysts can get to know everything about the industry and the 20 or 30 or so stocks they cover, because as I start walking through this analysis, you're going to see that it is a lot of work, and it's why I boil it down to the critical steps that you need to find your own stocks. While I almost went blind creating cash flow models in Excel, living inside the company's financials and footnotes line by line, I'm going to show you how to do it, focusing on the fundamentals of a stock. While I was mainlining caffeine, and many analysts were abusing the Bloomberg bump, a mixture of Red Bull and Ritalin, I'm going to show you how to do your analysis in an hour or 2, but I want to get your input here. I showed you last week why I like that top-down investing process, so I can cover more stocks and see the bigger picture, but which would you rather do? If you were an analyst on Wall Street, would you be a top-down or bottom-up analyst? Let me know which strategy you like best and why in the comments. Another group of stocks you probably wouldn't be looking at with the top-down process, with energy, and here Permian Resources, ticker PR, caught my eye researching for this video. Record U.S. oil production and fears over slowing growth have pushed oil prices down to the low 60s per barrel, and stocks in the energy sector are down 3% over the past year, the second worst performing sector. So this isn't somewhere that top-down analysis would lead you. But the $750 billion energy deal with Europe and a floor of support for oil prices makes me think now is a good time to start looking at these stocks. And we've always held on to channel favorites like Devon and Diamondback Energy here, but putting this analysis together, there is a lot to like about Permian Resources. It's the smallest of the group, but was able to put up some amazing growth through acquisitions over the last 3 years and a best-in-class profitability. Against peers like Devon and Diamondback reporting negative free cash flow, Permian is still positive and growing as cash generation. It's more expensive than the others, but again, it's expensive for a reason. But another part of this bottom-up process is going deeper into these stocks to validate what those numbers are implying. Here you want to go to the Investor Resources page for any publicly traded company. Here you're going to find the news releases, business updates, and usually an investor presentation full of charts on how the company did in its quarterly report, as well as guidance for future performance. Now, one thing you need to watch for when analyzing stocks, especially oil companies, which love to compare themselves against peers, is you need to understand what a company isn't saying is just as important as what it does say. For example, Diamondback likes to report its free cash flow margin and capital efficiency versus peers, though it doesn't label the peers, so you can't double-check their numbers. It also doesn't disclose well how it's adjusting this cash flow number because we see here on Yahoo Finance a negative free cash flow, so there are some heavy-handed adjustments here to make this cash flow positive. For its part, Oxy felt the need to highlight its Delaware Basin well performance versus peers, and I'm not sure that's a big deal for anyone but Oxy. And Permian highlighted its low debt leverage versus peers, and here it did label the other companies, so points for transparency there. It's one of the reasons most analysts specialize in a group of stocks and an industry, so through the experience of following all these companies for years, they learn what measures are important and which are just window dressing put on by management during earnings. Following a group closely, you're going to get a feel for what management is talking about, and more importantly, when they're suspiciously quiet about something others are highlighting. But that time and research will pay off. When I started watching Home Depot in 2012, housing was still shaky and nobody wanted to touch retail, but I saw accelerating revenue growth, up just 3.5% for the year before, but almost double that in the first quarter, and a giant 28% increase in operating profits. Management was turning the ship, and years of cost measures was amplifying that momentum. And when I looked at cash flows, cash from operations was up 45% on the year, and free cash flow up 55% to $5.4 billion. Now, Home Depot wasn't the obvious top-down play, and nobody got excited about it when I pitched the recommendation in morning meetings, but that boring pick would become one of the best returns among the firm. Nation, I know this kind of analysis can be a grind, but when nobody else wants to do it, when everyone else just wants to herd into a few stocks like the Magnificent Seven and call it a day, that grind works and will find you better stocks. I'm going to reveal another stock next, one Wall Street hates right now, but where I found a wave of cash flow coming and could boost it 50% higher, but don't miss the rest of the videos in this stock picking series. I'm going to link to the first video following that top-down analysis, my favorite investing strategy. I'll be following this one up with others in financial ratios, stock screeners, and how to tell when a stock is too expensive. I just added Charter Communications, ticker CHTR, to my list after plunging 33% on its most recent earnings, but undiscovered upside here that could make it a surprise winner. Now, from the big picture perspective, everyone hates telecom stocks. It's low growth and subscriber losses in most cases, hugely capital intensive, spending tens of billions of dollars in infrastructure, and the upside is regulated down. On the fundamentals, Charter may be the best house in a shitty neighborhood, but it still doesn't mean I want to live there. Revenue growth of just 2% and 24% operating margin makes it the best in the group, but all of these are hemorrhaging cash on an infrastructure upgrade cycle. But then a boring little change in the tax law snuck into the big beautiful bill could see a cash flow boom for Charter and surprise everyone. The bill will allow Charter stepped up depreciation and expensing, basically zeroing out its taxes to save billions. Estimates are that Charter could see a 39% boost to its free cash flow, amounting to an increase of $1.7 billion from the current $4.3 billion in FCF. That cash flow boost is enough to bring investors back for a second look, and the upcoming merger with Cox Communications could be a competitive advantage in scale that is going to take these shares further. I'm not ready to say this is a long-term buy and hold, but the 1 or 2 year timeline looks very good. That cash flow boost for Charter, that's going to be a giant catalyst that's going to bring analyst buy ratings and investors back. And that's one of the most important parts of this bottom-up process, a catalyst and a timeline for that to happen. That's because you can find the best stock in the world, folks, but without knowing when the rest of the market is going to see it, you're just sitting on dead money for what could be years. So your final step in finding the best stocks to buy is to list out the events that could bring investors back and that timeline for each. Most of the time, this is quarterly earnings reports where the company surprises the market with what you've been watching, but it can also be new products or news around regulations and new contracts. For earnings reports, you can go either to the company's investor relations page and its filings or search the SEC Edgar database. Here you're looking for 8K reports, which are the financials a company releases every 3 months. And you can see companies tend to report these on a repeating schedule around the same day on the same months each year. So that makes it easier to know when those big turning points might come, when the company could release information that brings those investors flooding back. For my call on Home Depot, it was the February 26th report of its fourth quarter and full year 2012 results, announcing a $17 billion share repurchase, increasing the dividend by 34%, and providing blowout 2013 guidance. The stock jumped on the news and was 23% higher within 2 months, but with the market still skeptical on housing, it traded flat for another year. I stuck with it though, and it was the second quarter 2014 report on August 19th with an updated guidance that showed everything I was tracking, smashing estimates and driving a 60% upside from there. Nation, that is when I realized this kind of bottom-up stock picking isn't just busy work, it's how you find the truth. Even for someone like myself that prefers that top-down big-picture analysis, sometimes your biggest winners aren't going to be in those hot sectors or the ones being pushed by those economic themes. They're hiding in the boring cash flow machines that nobody else is watching. It's only in this in-depth analysis that you get to know a company, its cash flow, its debt, and its advantages. That is how you spot the big returns, and it's why you cannot ignore this bottom-up stock picking. Check out the video on the right for the next in our series and learn in 20 minutes what it took me a decade to learn on Wall Street. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.